In this video, we're going to talk about at what ratios we should look at in stocks in different industries. This is based on James O'Shaughnessy research and his book, What Works on Wall Street. So let's get started. First of all, let's imagine for a second that we measure the stock performance from 1964 to 2009. And what we do is that we take 20% of the stocks that have largest price to earnings ratio, and we take 20% of stocks that have lowest price to earnings ratio. According to efficient market hypothesis, the performance should be exactly the same, but that is not the case. The average annual compound growth rate for 20 lowest price to earnings stocks was 16.25%. So that is 5% difference against S&P 500. If you think that is not much, let's look at what happens to 10K invested in 1964, and in 45 years it will be 10 million. On the other hand, if we invested 10K in S&P 500, we will get almost 1.3 million. So that is almost 9 million difference in 45 years. Almost 10 times you get more money. Every percentage matters. What we're going to do next is we're going to look at different industries. And what James O'Shaughnessy did is that he compared different ratios in different industries. And what I'm going to show you is the result of his research. Let's start with the materials sector. As you can see at the top of the list is enterprise value to EBITDA. EBITDA stands for earnings before interest and tax, depreciation, amortization. So this was the main ratio that we should look at. 16% versus 5% of performance of cumulated average growth rate. As you can see, there are value composites. Value composites are a combination of several metrics. But what I want to focus on is individual ratios. It makes the system much simpler. On the bottom of the list, we can see metrics that have very little effect on performance. Metrics like market cap. So it doesn't matter if you buy large cap or small cap, the performance, the history tells us, will be almost exactly the same. Okay, the next sector is communication services sector. Companies like Verizon, AT&T. As you can see, price to cash flow is at the top of the list. So that is the main metric we should focus our attention when we're analyzing stocks from communication services sector. Then we have consumer cyclicals, companies like McDonald's, Nike, that are very sensitive to business cycle. We can see that enterprise value to free cash flow is at the top of the list. Okay, next, consumer defensive. Companies like Coca-Cola, General Mills. What was a surprise for me is to see dividend yield at the top of the list. What is important for consumer defensive is really dividend yield. So that is the main indicator of great performance of the stock. History tells us. Also shareholder yield, which means that it includes dividend yield, shares buybacks, and debt reduction. Also, we can see that momentum and market cap has little effect on stock performance. Then, energy sector. As you can see that price to earnings, EV to EBITDA has the largest effect. Almost 17% versus 2.2% of performance. As we can see, the market cap and the momentum has little effect on the stock performance. Finance, buyback yield, price to cash flow, EV to EBITDA were the main indicators. Market cap and price momentum had little effect on performance. Healthcare, price to cash flow, price to earnings are the main ratios to look for in healthcare stocks. Industrials, enterprise value to EBITDA, also shareholder yield at the top of the list. Information technology, so companies like Apple, Microsoft. Price to sales is the main indicator, so 12% versus 4%. Also, the market cap has little to no effect on the stock performance. And in the end, utilities. So again, EV to EBITDA and price to cash flow. Return on assets or price momentum had little effect on the stock. As you can see, enterprise value to EBITDA has the most effect in almost all the sectors. Okay, to summarize things up, the main indicator that had the most effect on stock performance was the enterprise value to EBITDA, which I believe the similar metric had the most effects on stock performance. In the book Acquires Multiple. These are the same conclusions. Also, which was a surprise for me, is that in consumer staples category, the shareholder yield and the dividend yield were the main indicator of the good stock performance. So that were the main takeaways. If you like this type of content, please subscribe by pressing this button, and see you in the next video.